KESM Industries Berhad was co-founded by a humble Singaporean gentleman, Mr. Samuel Lim Sim Soo, in 1978. The company is in the ancillary services, basically providing support to the primary activities of an organization, and the company provides services like the burn-in and testing services to the semiconductor industry, and they have a business presence in Malaysia and China. You can visit their website at KESMI.com for more information. Hey guys, welcome back to my channel again. Just want to share with you the agenda for today's video. So today we are going to be going through the KESM's 10-year financial data, where I will brief you through its top 10 shareholdings, the revenue, cash flow and dividend, etc., the overall rating of the company, and I've added a few more insights that I've researched on this company. Basically, I'm going to share with you who are its competitors in the industry, and then the financials comparison between KESM and their competitors. And last but not least, I'll end it with my own takeaway, where I share with you what are the benefits and risks of this company. Alright, so without further talking, let's hop right into it. Based on the top 10 shareholdings of this company, we can see that the number one shareholder of this company is Sunride Limited, which is actually owned by Mr. Samuel Lim himself. So I actually put over here already that Mr. Samuel indirectly owns about 48.41% of equity in KESM via Sunride Ltd. Alright, so yeah, you can go through these top 10 shareholdings. You can just pause here and watch it again. Now let's go to its revenue to gross profit. Its revenue to gross profit, at first glance, it looks quite alright. It's progressing up slowly from 2011 to 2018 until 2019 and 20. The reason is because in 2019 there is the US and China trade war. So that actually negatively impacted the whole semiconductor industry. Whether it's KESM or other companies like Inari or MPI or Vitrox, basically every semiconductor industry got hit because of this war. And in 2020's case, it's because of course, the COVID-19, the restriction of movement, MCO, CMCO, that caused some of the supply constraint and is unable to ship their products to its customers. So let's dive into the analysis of the revenue to gross profit. In 2015 to 2017, their revenue increased. I think you would notice the explanation for their revenue increase is because of the higher demand for burn-in and test service. So sorry, hold on a moment. And which actually, once their revenue increase, this would also automatically drive up their gross profit. And KESM is a company that does not have a lot of cost of goods sold. Later I'll show you how is their gross profit margin is like and all in the upcoming slides. But yeah, we'll talk about that more later. And I also got to talk a little bit on the drop during financial year end 2019 and 2020. It's because of the US-China trade war, lower demand of cars that is needed in China and US. Why does the lower demand of cars will affect KESM? Because KESM actually changed their business strategy in 2015, if I'm not mistaken. Initially, they focused on focus on testing on semiconductor like our laptop chips, our smartphone chips, and also the automobile chips. But starting in 2015, they start to only concentrate on just testing for the automotive industry. And that is the reason why when there is lower demand for cars, it will also affect KESM because there's lesser chips to be tested, right? Besides all of those mentioned constraints, they also have interruption of their customer supply chain due to COVID-19. Yeah, so basically all of the businesses are actually got restricted because of the pandemic lah. And if we go through its revenue to operating profit, during 2012, financial year end 2012, their operating profit actually dropped 41%, and that is because of the lower revenue and higher cost of goods sold, because there's a lot of changes in their customers' product portfolio, and also because they overestimated China's production. Basically, they thought that China is going to have a very huge and large ramp up of their production, and hence KESM actually bought a lot of capital expenditure, a lot of equipment to prepare for those for China's ramp up. But in reality, the ramp up did not meet KESM's expectation, and hence there's a lot of obsolete equipment that is not used for those for China's production, and this actually result employment loss in inventory. And also to share with you is that KESM business actually requires them to have a lot of engineers and workers for their business testing, so it is very important for them to have the worker retention. Looking forward to its 2013 to 2017 financial year end, its operating profit increased by 210% because of the rise in demand for microcontroller chips. And also the group has achieved a higher other income. Basically, they have a stronger USD currency, foreign exchange, and also a gain from the disposal of investment in securities and property. Likewise, for 2018 to 2020's case, it's because of US-China trade war and also the COVID-19 pandemic that caused the operating profit to drop 83%. Now we go to its GPM, OPM and NPM margin. So you can see that its gross profit margin is all well above 50%. This means that 50% of the revenue contribution is from its cost of goods sold. So this shows that they don't really spend a lot on COGS. It's because those inventories that they bought, the raw material, the consumables, the finished goods and whatnot, is all actually for its second core business segment, which is they also sell EMS, electronic manufacturing services. They provide those kind of services as well, which contribute about 30% of its total revenue lah, if you read its annual report for the past 20 years. But in 2020, if I'm not mistaken, its revenue for EMS is actually gotten lesser. It's only contributing, I think, less than 10% of its revenue. So that is one thing that you want to take note of, is that 70% of their revenue actually comes from the testing, burn-in testing service, and about 20 to 30% is come from the EMS business segment. So you can read my explanation, it's all over there already. Just pause the video and have a look. Now we can take a look at its remuneration to profit after tax. Personally, I feel that the management actually has been very conservative in paying themselves. I've noticed that when there are times where they are not really making a lot of profit, the management team actually reduces the remuneration. So that is something that is what I like to see in company. When they didn't manage to deliver, they also basically like, hey, since I'm not performing, I think I deserve a cut in my salary or bonuses. So that is how I see companies lah. But if let's say they manage to deliver, of course I'm happy that if they pay themselves more. You can see my explanation is that on average, the PAT to remuneration is about 11.47%. And its profit after tax has been growing steadily until 2017. 2018, 19 and 2020 is basically the year of US-China trade war and also the COVID-19 pandemic. But in 2020's case, the remuneration actually skewed up to 1,796%. So this is actually because of its all-time low profit after tax. Partly is because of its tax expenses that actually rise up to 73%. This is something that I'm not sure why. I thought that their tax would be lower, but then when I read their quarter report for Q4, the tax expenses is actually deducted 96% of its profit. So this is something that is what is happening to the company. Basically, they don't really have any like tax incentive, unlike the ATE industry like Greytech, Vitrox, MeTech, and all the companies, and also for the OSAT companies like Inari, MPI, they don't have the pioneer status. Basically, pioneer status, it is an incentive that is given by the MITI, the government, MITI, so they can have actually a tax incentive for the product and services that they provide. But in the case for KESM, they don't have this kind of incentive lah. So that's why you notice that their tax expenses, the percentage is always around like 24 and above %. And now we go to its total borrowing to its cash. First glance, you see you know that it's very healthy. They have more cash than they do debt. So they have been in a net cash position for 10 years and it's growing very steadily. This is actually an advantage to KSM because with more cash on hand, they can have the opportunity to buy more equipments without raising any fund, without borrowing a lot of debts or whatnot. They can just actually use their cash to buy those equipments. And if we go to its operating cash flow to Capex, how I see is also alright. There's not much to comment on. The times there where the Capex is higher than its operating cash flow is usually due to the unsold inventories and also the decrease in trade payables. Unsold inventories is more towards its EMS business segment rather than its burn-in testing. Its EMS is I think they're selling their product also. They bought a lot of raw materials and whatnot, and then they mix and match. They combine all of those chips and whatnot into the plate, and then they distribute it to its clients. So those requires more raw material, more inventory and whatnot. And it's 2014 and 2017 and 18 is basically due to the increase in purchase of burn-in and test equipment. That is actually totally normal because KESM is in an industry that they have to spend money on Capex, on capital expenditure, so that they can increase their sales. And you need to know that if they are not really spending a lot of Capex, this means that there is a lower in demand for their sales. So in turn, if there's actually a rise in purchase for Capex, this means that there's a higher demand for their services, right? And its dividend payout is actually very good, I would say, because they have been paying dividends for the past 10 years. However, in 2019 to 2020, its dividend actually dropped, and that's actually totally fine. It's because of the US and China trade war as well as the pandemic that actually impacted their profitability. Its free cash flow to dividend wise, I see it as also a pass. It's alright. There are many times that they have a positive free cash flow, which is very good. Not many company has the capability of generating a positive free cash flow most of the time, whether is it in the offset or whether is it in the ATE industry. So mainly why they have a negative free cash flow in financial year end 2011, 2014, 2017 and 18 is because of higher Capex, and some certain years they have a lower operating cash flow. You can read it in the previous slide where I've actually further explained about it. How they manage to pay dividend even though they have a negative free cash flow is because KSM has a very high cash reserve in their company. They're actually in a position that they can distribute dividend from their cash or maybe even from their retained profit, because they actually have been generating profit for the past, I think, 30 to 40 years. Ever since IPO, there is actually not a single year they actually declared a loss in their company. So that's actually pretty impressive. And finally, we have the overall rating for KSM. Basically, I gave them a rating of about 77.5%. It's actually quite good in my personal opinion. Yeah, nothing much to comment about it. I actually basically run through my explanation of each slide, so you can actually watch back on that. And next, so today I did a little further research on the burn-in and testing industry. So I found out that it's very difficult to find its competitor, because in Malaysia there's not many companies that do burn-in testing services. So I think KESM is the only company that does that. And in a global scale wise, there's actually a lot of companies that does these services, but they are private companies. So this means that their financial information, they are not released to the public. And if you want to get it, I think you need to purchase it in certain website lah. So which I don't have the money to buy to do my further research. But what I found is basically there is 3 companies that do these burn-in testing services. What I found is that KSM, of course, is one of them, and the other 2 is TRT and AEHR. Sorry, let me see what is TRT's name. Okay, so basically the other 2 competitors of KSM is TRT, Tech International. This company is a public listed company that is listed in the New York Exchange Composite Index. Same like the 𝐒𝐔𝐁𝐒 test system, which is also listed in the New York Exchange Composite. And other companies like Microcontrol, EDA Industry, and Test Solution Services, they are all private companies. You can actually have a look if you want to. So I did a financial comparison between these three companies, KESM, 𝐒𝐔𝐁𝐒, and also TRT. So it's market cap, enterprise value, revenue, and also net profit. Basically, how I got all of these financial data is through Share Investor. It is a paid website. You can actually Google Share Investor and then you see what is their packages like. You can see that in the case for KESM, their revenue and also net profit is actually the highest among these three, and it's also the most largest out of these three companies. By the way, I forgot to mention this. All of these numbers that you are seeing, they are all in the currency of Malaysian ringgit, RM. It's not in USD. I converted everything in ringgit Malaysia. Its revenue and 5-year growth comparison wise, KESM at this trailing 12-month period, they actually earned the most revenue compared to its competitors. However, its revenue growth has been declining. The decline is actually due to the US and China trade war and as well as the pandemic. Initially, they have been growing quite positively on an upward trajectory, but because of the trade war and also because of the pandemic, that result their revenue to decrease down. You can see in my previous slide, I have actually explained it over there already. And in the case for TRT and 𝐒𝐔𝐁𝐒, they have actually been growing quite steadily, although for TRT, it's actually growing very slightly, only very little. It's about 0.31%. And for the case of 𝐒𝐔𝐁𝐒, they have been growing quite well. It's actually double digit at 17.35%. Its gross profit wise, a similar case, KESM has been generating the largest gross profit compared to its peers. However, it's on the decline. It's because of the mentioned constraint, the pandemic and trade war. TRT also, I think they have the same impact. I didn't really study much on TRT, so that one I cannot really give so much comment. Maybe it's because of the management is not doing well, or maybe because of this the trade war and pandemic that is affecting them. For 𝐒𝐔𝐁𝐒 case, is actually doing quite well. It's also generating about 17.12%. Its net profit wise, KESM has not been performing that well. Its 5 years growth actually dropped 65.95%. So that's actually a very huge drop. But its recent quarter report, I see that they actually have been improving. I think they are actually going smoothly now that the MCO and CMCO has been starting to lift off, and then there's more vaccination is coming in. So I think their business will go back to normal. But one thing to take note that in the automotive industry, they have a very huge shortage in the chips for the automobile. So this is something that you need to take note of, because when there's a huge shortage in chips, means there may be a potential risk that there is a lesser car that can be sold because there's not much chip to produce. So means you cannot produce much car. And when there's lesser car that's being produced, means there is lesser testing services for KESM to provide. This is something that you need to take note, but nonetheless, shortage can also means it's going to give a benefit, because production capacity will be going up to the roof, means KESM will be very busy. They have to test a lot of chips once all of the chips are actually made available by the front-end players, which will actually result huge sales. But we'll see how severe the shortage of the global shortage of chip will be lah. Sorry. Now back to its this slide. So for the case of TRT and 𝐒𝐔𝐁𝐒, both of their net profits growth has been growing quite steadily, about double digit, 13.14% for TRT and about 16% for 𝐒𝐔𝐁𝐒. Although 𝐒𝐔𝐁𝐒 has been making a net loss in the trailing 12 months. You can see that they are making about 18 million in net loss. So yeah, that's about it. And for its Capex wise, KESM has been spending a lot of its Capex. I think they are preparing for the ramp up in production. If let's say there's a lot of chips that is needed to be tested, they're actually ready for it, since they got all those equipment in place already. However, its growth for Capex spending has decreased by 30.85%. It's because in 2019 and 2020, there's actually lesser demand for car sales, and also because of the trade war and whatnot. And for the case of TRT and 𝐒𝐔𝐻𝑒, TRT also has been reducing their Capex expenditure for the past 5 years. and 𝐒𝐔𝐁𝐒, they have actually been increasing their Capex in the past 5 years. Its inventory turnover wise, by the way, this inventory turnover is measured in times, yeah. Inventory turnover basically means how many times the inventory is used as the cost of goods sold for their product and services. Basically, they turn inventory into cost of goods sold. So this is what we call inventory turnover. And generally in this industry, the higher inventory turnover, the better, because this means that you are consistently converting your inventory into sales. So this is something that you want to see in this kind of industry. You want a very rapid and fast conversion so that you can get cash. So in the case of KESM, it has the highest inventory turnover among its peers and also the industry. It's about 24 times. In the case for TRT and 𝐒𝐔𝐻, TRT is still somewhat okay. It's slowly catching up to the industry's inventory turnover benchmark. However, for 𝐒𝐔𝐻 case, it shows that they maybe have like a difficult time to convert their inventory into cost of goods sold. This maybe you want to have a look. Why are they having a hard time to do a better conversion as compared to its peers? If let's say you are interested in investing in 𝐒𝐔𝐻. And last but not least is the cash conversion cycle. So what does cash conversion cycle means? It's basically how fast does the company takes for them to convert the raw material that they bought and change it into sales or product or services that they sell it to their customer. So that those duration is called cash conversion cycle. In this case, it's actually opposite of the inventory turnover. The lower the cash conversion cycle, the better. It basically means that the company is having a very great productivity in making their sales. So in KESM's case, they have the lowest cash conversion cycle, very good as compared to its peers. They are doing a very good job in managing their day-to-day activities. And this also means that their sales team are actually very good in converting their product and services into sales. And yeah, you can see that 𝐒𝐔𝐻 has the largest cash conversion cycle. I'm not sure why, maybe you want to have a research about that. Last but not least, here are my takeaways on the benefit and also risk of KESM. So firstly, the company has a strong management team. Ever since IPO, they have been consistently delivering what they promise. And on top of that, if you read the entire annual report from 2000 to 2020, there's actually not much changes in their management team. It shows that the members are actually very loyal and there's a retention that glued their relationship till this day. And in addition, KESM has been a profit-generating machine. And what I mean by that is that the company did not make a single loss since 1999, and which is, I find it very, very impressive. This shows that the company is actually managing their operations, sales, and all very, very well. And to top it off, their operation cash flow has also been consistently on a positive for over 20 plus years. This indicates that their core business activities are thriving. Now, what are the risks that you need to know is that the burn-in and testing industry is in a very, very competitive environment. And according to Mr. Samuel, the founder of KESM himself, the company actually expects not only price competition in the market, which could lead to pressure in the profit margin, but also competition for qualified personnel, which may hinder them from staff retention. And besides that, there has also been a rising in labor costs in China over the years. For KESM, they actually have a business presence over there. Hence, the rising fixed cost is something that the company may need to bear in the near future. And lastly, I think that we all know the semiconductor industry, it is very cyclical in nature. So you can see that there are times that where demand of their service is very high, and also there are times that they are not so high and they are very low. Nonetheless, in the long term, the industry is definitely ever growing with the rising demand for more advanced technology and also the overall improvement of standard of living. So yeah, that's about it. I hope you guys enjoyed the content that I provide to you so far. If you did, make sure you smash the like button and also subscribe to this channel for more contents like this. And also don't forget to comment on what company you would like me to analyze, and I may post it on my next upcoming videos. And with that said, I will see you guys in the next one. Bye bye.